So what do we mean by rates go back to the future? Well, a few things. First of all, we assert that the pandemic-induced inflation spurt has shocked the rates market back into normality. And secondly, that means that when we look at 2025, barring a shock, we shouldn't be expecting a return to ultra low rates. In fact, when we look at 2025, we see risks being dominated by tariffs, tax cuts, fiscal policy and the like, which puts upward pressure on rates. But relative to what? We have looked at the noughties and averages during the noughties as presenting an interesting set of levels for normal rates. So the Fed funds rate averaged 3% and the 10-year Treasury yield averaged 4.5% back then. And for 2025, we think the curve should land at least 50 basis points above those levels, reflecting the stresses that I just spoke about. For the eurozone, it's a bit different. There's an element of macro malaise ongoing in the eurozone, and a lot of the pressures in the core, which means we don't necessarily anticipate significantly wider spreads. And I guess there's a silver lining there because we're not anticipating any type of eurozone crisis. So the big spread story really is between the US and the eurozone. It's already wide, but it can widen further. In our rates outlook, Back to the Future, we cover these topics and we also cover the wider spreads environment, SSA space and supply. Enjoy.